I love that intro so much. Let's go on, everyone. We're going to do a Let's Look Live on OML or O Media Limited. Now, I haven't really done much prep for this, so this is just going to be a grind to look through the financial data and come up with some kind of target, both take profit, entry target, and stop loss. And what we'll be doing, or rather what I'll be doing, is putting in the description below the key information or the timestamp for the key information, because God knows how long this will go for. 20 minutes, an hour, I don't know. So we're going to have a grind through all the financial data we can, all the relevant data, the chart, and of course, just some basic valuation. So OML is super ugly. So let's start with the chart. Now, most stocks have bounced to some extent. OML, not so much. So I drew these two horizontals here, the red lines, and this is the daily chart for OML. Now, I figured I'd rather do this live so people can get a sort of an insight to how I look at things and how I research, rather than just cutting to the core pieces of information and just compiling a video. That, and I'm feeling a little bit lazy. It's Easter and I can't be bothered doing a video. So we're doing it live. So what we have here is a simple trend line. A simple trend line in yellow. And these are the horizontals from when OML first IPO'd back in 2015. So quite a while ago. You can see it's had some ups, downs. It's been pretty stable. It's had some dividends. And it's been a relatively stable company. Now, O Media Limited, to my understanding, they are almost entirely outdoor advertising. So if you see an advertisement on the road, it's most likely O Media Limited. AdSense, I think it was AdSense, used to be a pretty big player as well, but they got bought out by O Media Limited. So to me, AdSense is a more familiar name, a more familiar brand than O Media Limited. So I don't know if it's O or U. Anyway, so OML bought them out for a few $100 million, and we'll go into that a bit later. But you can see here it's starting to turn, and if I bring up the 1 hour chart, you can see it's had some positive divergence. In fact, ever since 10th of March, every time it's sold down, it's just gotten stronger and stronger. Now, it's not significant. It's not overly significant. And this is why I mentioned that one should never enter a position based on divergence. It just tells you that the selling is getting weaker and weaker. So we hit a point here where it seems to have started to bounce. Now, if I bring up the daily chart, I think that's about 3 days worth of that's more like 5 days. 1, 2, 3, 4, 5, 6 days of sideways action. Now, a lot of this is due to the capital raising that I did. Now, I'll bring up capital raising in regards to DCN. Now, DCN had a 70% cut. So in my previous video, you'll see DCN had a huge capital raising. 140% or 130% increase in shares on issue. And they did a huge discount, like 70 to 80%, I think it was. 60 to 80%. They did 2 different raises and of varying percentages. So let's go through what these guys have done. Now, they did a late capital raising. Now, this was, I think, 26th of March, or 16th of March, sorry. So if I bring up the chart here, we'll see exactly when the capital raising was initiated. So where is it? 16th. Sorry, it was 26th. So you can see the gap, 19th of March to 27th. There was a hold period here, a trading halt, and capital raising occurred right here, right at the bottom. That's an unusual choice for a company to do capital raising here, particularly when the entire market was selling down. Very unusual decision, plus they did a reasonable discount as well. So 20% and 37% discount. Based on a different variety of measures, last closing price and TERP, whatever the hell TERP is, theoretical ex-dividend price, I think it is. So they raised 130% of existing shares on issue. They had 245 million shares. They added on 315 million shares, giving them a total of about 560 million, give or take a few million. And there is a bloody cockatoo tugging at my my sheets that are on the balcony. Little shit. Anyway. So we got here a $156 million raised, and the offer price was 53 cents per share. So you can see here it's dipped almost, maybe it was 2 cents off. 2 cents off the cap raise price. Of course, they did 66 cents and 84 cents. But if we scroll down, there was an institutional component of the raise, and the offer price was 53 cents for them. So all up, we can see they released the shares, 293 million shares at 6th of April. So the big concern is the selling of shares when they come online. So when the shares came out, 6th of April, the share price was 65 cents. Doesn't seem like there was selling pressure from the additional shares that have come onto market. Whether those institutional holders want to hold it or maybe sell small portions as it rises, it's hard to tell. But it's a good sign so far that it's not just selling down. So the financial impact of COVID-19 is also an important one. Basically, these guys are saying we have no idea what our earnings are going to be. We have no idea what the impact is. And that's a pretty unfavorable position to be in. These guys have absolutely no idea by the looks of it. So they've pulled out all earnings targets. They don't really have anything except capital expenditure has been reprioritized to be at the bottom of this particular range of $60 to $70 million. So that's about the only target they really have. They're just remaining vigilant on costs and maintaining strict cash flow. So you can imagine advertising probably isn't that great at the moment, especially outdoor advertising, which is the focus of this particular company. So we can look at, if we go into their financial documentation, so for pretty much till December 2019, we can see their gross profits, and they're doing quite well. Now, these guys implemented a different method of accounting. They mention it at the top of this document here, the 4E, I think this is the annual report. And basically, it's an AESB 17 or 16. It's just a different accounting method. I'm not too familiar with different accounting methods, so all I'm interested in is the actual financial reporting. So that's all that matters to me. Gross profits, $464 million, and at the end of it, they really end up with about $13 million profit. That's seems a little bit low considering these guys were trading at, what was their market cap quite recently? So let's say at the peak here, $3.20 for 245 million shares. That comes out to 3.21. So that's before cap raise. So they sat at 800 million market cap around this point in time. And at the moment, they're sitting at 430 million, which is about right. So if I do 560 million shares multiplied by 76 cents, which is what they're on at the moment. So 425 million is what they're on at the moment, which is pretty much bang on with the market cap that's showing on Hot Copper. So we can see their gross profits increasing, but overall their net profit after tax is decreasing. So let me just have a look at what that could be. Total expenditure. Okay, they're spending a lot. Okay, so here we go. So the losses have come as a result of depreciation and amortization expenses. So that's effectively paper losses. We'll look into that a little bit further. Now, if I scroll down and we look at assets, these guys are running at total assets of $2 billion worth of assets with $1.4 billion worth of liabilities, giving them a net position, a total equity of $665 million. Now, right off the bat, you can see that they're trading at $430 million and they're trading below equity, right? So again, an explanation of equity is basically if they sold everything, they just dropped it all, sold out the business, their entire value as a business is $665 million. In theory, that's a very basic way of looking at it. And then, of course, you've got pretty decent gross profits coming out, and gross profits which have doubled. Not quite doubled, but very close. Operating profit has also gone up quite significantly. So really, it does come down to this this depreciation and amortization. So we'll look at note 11, 12, and 13 to have a look at really what is in decline here. Now, a big portion of the assets, let's just have a look here, sorry. So this is consolidation. What's the difference between these two? Whoops. Okay, so these guys, 665 million in equity. That's all well and good. So if we look into their non-tangible assets, that's basically things you can't really see, touch, or attribute any kind of physical presence to, right? So goodwill is that effectively. So these guys have taken over and bought out AdSense for hundreds of millions of dollars. I think it was, I'm not sure if this was it, 512. I think it was more like $570 million was how much they bought it out for. Now, goodwill is an interesting one because it is effectively, you're buying a brand is what you're doing with goodwill. You're buying a loyal customer base. You're buying perhaps a management board, like an existing board, and they might contribute a significant amount of value, right? If you buy out a company that has Warren Buffett on it, you're going to pay a substantial amount of goodwill, I would imagine. If you buy out Pepsi, you're going to get a hell of a load of goodwill. You're not just buying their assets, you're not just buying their equity and their gross profit potential. You're buying goodwill, and you're going to pay a hell of a lot of money for that goodwill. So that's just a summary of what goodwill really is, and we can see that $350 million of their non-tangible assets or their total equity, a chunk of that comes from goodwill. So that is worth noting. So the interesting thing with this company is that they're trading below equity. Now, that's something that hasn't really happened during this COVID-19 sell-off. You can see there have been minor attempts at bounces, and this is on the 1-hour chart. And these guys have basically just plummeted because of lack of consumer confidence, really. So one might look at the company and go, right, well, these guys have $660 million in equity. Let's say if we look back at their revenues, one could say that maybe they're going to cut down their revenues quite significantly because people just aren't going to pay for advertising. Because who's outside at the moment during a lockdown? Not many people. These guys aren't going to be advertising in airports. You see advertisements everywhere in airports. And I imagine OML has a big part in that as well. So their revenues are going to be cut. They're going to be heavily cut. So let's say they operate at half. And mind you, this is a full year view, right? So let's say for the first half of this year, so 649, divide that by 2, let's say $324 million would be their original first half year target. And maybe we'll divide that by 2. 162 million is going to be their first half. Possibly. I don't think a 50% cut is too unreasonable. This is a guess because no one's really gone through something like COVID-19. Now, 50% is probably a conservative number. You could probably it's probably not conservative, actually. Something more like 75% would be conservative. So you can see that they're going to take quite a huge hit in the first half. Since start of March till perhaps the next 2 months from today. And that's obviously going to have a significant impact on their revenue. The question is, let's say these guys are back at below $200 million for the full year, maybe a bit less. They'll be operating at maybe $150 million loss after tax. Let's say they lose $150 million. Let's go back to equity. 665 minus 140. They'll be trading at about $525 million, assuming they take that much of a hit in first half numbers. I don't think that's too unreasonable. 525 million from the 430 that exists at the moment. So 430, 525. There's at least wiggle room to move up 22%. And 22%, let's say 76 cents times 1.22. 92 cents would be a reasonable valuation, I would say. Now, some people ask the question of like, well, if there's that much value in the company, why did it sell so much? Or why does anything sell so much? Why does anything get overvalued so much? A company never trades at its fair value. Very rarely does it trade at fair value. It's going to be a little bit more because people are expecting profit numbers to come in, so perhaps better profit guidance, better targets are hit, or perhaps they don't meet those targets and it sells down because there's less confidence in the market in that particular stock. I mean, there's a wide variety of reasons why a stock doesn't trade at its value. It's whether it's going to grow more, whether it's going to go in decline. It's pretty rare to see something at fair value. But when we see something go below fair value, that's when we sort of lick our lips and go, God damn, this looks delicious. And I would say OML falls in that delicious category. Now, comparing this to something like DCN, yes, it took a hit. I mean, 130% increase in shares is nasty. I don't think that happens too often. It's starting to happen. Like this is the second stock in a short amount of time that's done this. So I don't know if that's becoming some sort of new norm in this small to mid cap environment, but it's pretty dirty. Now, just a quick look at the questions. That's WACC, depreciation, amortization compared to gross margin. I've seen depreciation and amortization being extremely big on balance sheet. Why? Depreciating a value of a company, that I don't know too much about how companies do depreciation. It's effectively a write-off on paper. I know for IT companies how they do depreciation because I've kind of worked in that environment and I've seen, the value of software going in decline or it's just not being used as often. The market's moved on and they just write that off. They write off their asset, an intangible asset, and they write it off. And it's just an accounting tool saying that their product has less value now. I mean, I don't know how amortization and depreciation would work in an advertising company exactly. So that's why I want to look at section note 11 and 12 and perhaps get a better understanding. So we've got note 14 there. 13, this is the purchasing of the other businesses and how they've calculated everything. So once they've taken over the business. So right of use assets, depreciation for the year, that doesn't really tell us too much about what they're depreciating. Note 11, plant, property, and equipment. Okay, well, this isn't particularly helpful either. A lot of the changes in their accounting has come through this. This is the AAS B16 that I was talking about. And it's just a different accounting method that they've started to use. It's an Australian industry standard or an Australian standard of some sort that they've moved to. So this doesn't really tell us much about note 11, 12, and 13. It doesn't really tell us much about where the depreciation comes from or to what effect. Right of use assets. It just doesn't tell us too much. Amortization. So that's a delayed accounting method for, I think it was for revenues or for debt. Not sure exactly where or how they implement amortization exactly. Here we go. Okay, so the amortization is a write-off for licenses, the brand, and software. So just like IT companies by the looks of it. I'm not sure what they license exactly. But there you go. That's what they're writing off. It'll be these three. So I've always considered these write-offs to be just for tax purposes, really. That's why I don't put too much value into it, massive write-offs on intangible assets, because they're They're not tangible. They're not products. You're not writing off actual physical products. But at the same time, it doesn't mean that we shouldn't take value in intangible assets. What the company is effectively doing when they write off, whether it's licenses, brands, or the software, is that they're saying it's just less valued. Now, that's obviously significant because if the business is in decline, they're going to write off these assets, these intangible assets. Is this company good or bad news, TPG, Matt? The company is a mix. Now, my concern with entering a position on something like OML is it's been going sideways when the market's been going up. So this is the ASX 200. It's moving to the upside, and that's since, let me just bring up the vertical tool. So its reversal was the 23rd of the 3rd. Let's have a look at what happened here on the 23rd. Now, this is bad timing because this is when the capital raising happened, is when the market bottomed out. So this is the 19th of March and the 27th of March right next to it. So it was on a trading halt during this period. So that's very unfortunate. So 30th of March is here when the market's already begun its recovery. And it's already hitting the 38.2 at the same time as the US market. If I bring up the US 30, the hell? As the US 30 is hitting major resistance as well. Actually, let me bring it up on this chart here. So if we bring up the daily chart, we should see it's just hit the 50%, which is in line with the ASX hitting the 38.2. So it's hit a pretty key level here. Now, my concern is on Tuesday when the market opens is what happens with the US. Obviously, we trade a day ahead, so it might still be okay for Tuesday. Now, I don't expect OML to be a day trade. I don't expect it to just shoot up into the $1.40 range or something crazy like that. So we said 90, I think it was 95 or 96 cents was our fair value target, which pretty much coincides with this trend line here, this orange trend line here, which is the bearish move. So if it breaks out to the upside, I just don't actually see it hit $1.40. That's a bit ambitious. That is too ambitious. So again, if we look at equity, 665 million equity. I mean, even if we... Let me... Just a sec. So 665 million in equity, including the non-tangible assets. Where is it? So intangible assets. So yeah, so that's where a large chunk of goodwill comes into play. And the question is, how much are they going to write off the goodwill as well? And they've had $61 million and they've just raised another $135 million. And look, people have asked on the DCN video, like, right, they've raised X amount of dollars. Don't you just add that X amount to the equity? No, really, the market doesn't favor capital raising so much that they're willing to price it in. So really, I would look at this and I'd go, right, well, it's most likely a decent target to have 96 cents. Entry target will be interesting. Maybe 71, 72 cents. It really depends on what happens on Tuesday morning, whether this gaps up or whether this trickles back down. Now, the interesting thing about pretty much every other stock, every other mid to large cap stock, is that their initial bounce didn't really push forward. And this is really their initial bounce. So whether it comes back down to, let's say, No, actually, that looks good. 72 cents looks good for an entry. You'd never want it to go below. Probably wouldn't want it to go to 61 because once it hits that point in time, it's just like, well, it's just probably going to continue selling. So that looks all right. 72 cent entry just to make sure it gets there. Again, it's a whole if X then do Y scenario. So it'll be pointless for me to say 72 cents is a great target if it gaps up at 80 cents and just rallies. So you really got to pay attention to what happens on Tuesday morning. Now, this doesn't exactly have the best sentiment. Now, sentiment is exactly what drove this down really hard. Capital raising does not provide much faith in a company when they raise 130% equity, shares on issue, sorry. So, yeah, it wouldn't surprise me if it sort of just trickled down 72 cents range. I mean, the rational thing, the perfectly rational thing to do here would be have one entry target, one smaller entry, let's say 30% of your entire trading parcel at 72 cents, and then have something like the remaining 70% at 64 and a half or 66, somewhere in this range here. Depends how patient you are. And that depends if you're willing to enter here at 72. If you're willing to have 100% of your position here and then willing to have a risk, a stop loss here at 62 cents, then that'll be all right as well. I'm going to have to put that disclaimer out that this isn't financial advice. You trade at your own risk. If you lose money on this because of me, that's your problem, not mine. I mean, I shouldn't have to say that, but thanks, Seek. I really need to know the best opportunities for COVID-19. Now, I really do think that is the best way to trade this. 72 cents, 30%, and 70% at around 60, 65, 66. I think that'd be perfectly fine. Look, if you have a position here and then it rallies, you at least had a really, really good risk to reward, I think. I'm not going to bother figuring out the average for the risk. It's just that's what looks sensible. So you really do want a position that is much heavier towards your stop loss, and that'll be a moving stop loss as this trend line goes up. Now, the other consideration, and I did mention this before, is just about every single stock in the between small and mid cap did this. They dropped, they bounced quite heavy, they dropped again, and then that's when they carried on to the upside. So that's also worth considering that something may happen. But then again, the entire market moved like that at the same time. So if you do get stopped out, keep that in mind. There's always a re-entry on the way back up. So if you do get stopped out here, it carries on to the downside for whatever reason, there still is an entry potential because it'll be trading well below equity back here at 54 cents. In fact, that'd probably be a dream position to re-enter somewhere at this horizontal here if that happens. And you'd be saving yourself, what's 6 minus 5 divided by 6? So you'd be saving yourself about 17% if that does actually occur. But I still think that's fine. I haven't actually looked at this beforehand. Like I just opened the chart and I saw it was ugly, but I haven't actually decided on price targets. But on the initial look at things, this looks about right. I'm missing something. Of course I'm missing something. How can I miss my favorite tool? Now, just because I've established what I consider fair value around this 95-cent target, which happens to line up with this resistance, has no bearing whatsoever on market movements. So just because that might be fair value range doesn't mean it can't move up. I think it's a little ambitious. I mean, I said this with Afterpay and Qantas, that their bounces were a little ambitious, targeting anything higher than 17 cents, and it ended up just destroying those targets completely. So I don't know if I'm probably undervaluing the potential drive back up, because this was just a nightmare plummet. So if we look at this pre-cap raise, that was 245. Yeah, so that was 225. That was close to fair value before the shares were issued. But of course, fair value now is way back down here because of the issuing of 139% shares or whatever it is. Do I have any thoughts on the fact that OML is held almost entirely by institutional investors? No, I couldn't care less. A lot of, I mean, how many stocks that are nearly $1 billion, or in this case now $500 million, are held by mostly retailers? I don't think too many. What's your view on the upcoming week for the ASX overall? I mean, for the rest of the week, I expected the ASX to hit 50% Fibonacci, but it's the US market that got there. So the US 30 has hit the 50 quite comfortably. And this is a major bear trend from memory as well. So let me just bring up the daily chart. Yeah, so this was one of the key resistance points. So that's 50% plus a little bit more to hit this point in time and potentially keep going back down. I mean, imagine a recovery while there are tens of thousands of people dying in New York. Don't think so. Plus, unemployment rates in the US are just going sky high. And we got our unemployment numbers in 3 days' time. So I think that's Thursday or Friday. If you enter a position, how long would you hold for a stock like this? Well, I said Afterpay would be like a 1 to 2 week hold from memory. And that happened in a day. So I don't think how long is an important question. I really don't. And if you put a time limit on your targets, I think a time limit. I don't think a time limit is valid. You should look at how the US markets and the ASX as a whole are moving. Even if this is oversold, you're going to have downwards pressure from the entire market, the international market and the local ASX. So, if the ASX starts tanking really hard, OML isn't going to keep rising. It'll probably go sideways at best, if that scenario happens. From a balance sheet perspective, OML had such a great year, though. Yeah, it's... Did it, though? Here's the thing with OML's accounting. And if I go back up, the problem with OML, and this is where you need like someone who does accounting to really look at the numbers, because I don't know what the impact of this is, and that's this AASB 16. It's a standard that they've adopted, and they've got pre-AASB standards and they got post-AASB standards, and the numbers come out differently. Their gross profit's 283 million compared to 464 million. So that is a significant difference. And they explain the impact here. Significantly increased gross margin and EBITDA due to fixed lease costs now being excluded from gross profit and operating expenditure. It's like, yeah, but that expense still exists. Like it's just shuffled from one spot to the other. So yeah, so this standard has increased the gross profits, which, I mean, ultimately doesn't make too much of a difference because that the difference that exists here, the $181 million that exists here, is going to be inserted somewhere into here, whether it's depreciation, amortization, or just spread out across other parts. It doesn't make too much of a difference. If we look at the net profit after tax, okay, it increased. It decreased net profit after tax a little bit. So this is where that's out of my depth. I'm not an accountant. I don't understand the impacts. I should probably look into it, but really, I just can't be bothered at the moment. So I'll take the financial document for what it is. The post. I'm willing to take the more negative perspective and just take that number there, the lower gross profit and the lower net profit after tax, even though they're two different accounting methods. But I mean, if you want to play it safe, do it that way. Those people who attended my first webinar on the valuation tool, you remember what I said about profit margins and percentages? This isn't normal. 71.6% profit margin, even 43 isn't normal. If you remember what the range I mentioned was, then the valuation tool applies to that normal range. So this is well out of normal range. So it'll be 1x gross profit, and then even if you take 1x gross profit plus equity, I mean, you've still got a severely undervalued company for this point in time. And really, a lot of it comes down to capital raising as well. Capital raising, especially the way that they've done it, is just so detrimental to a stock price movement. The sentiment just nosedives. So really, that's my quick, like, half-hour run-through of the company. There's not much else to it. I mean, we can really dig in and dive into the numbers more, but I'm not an investor. I'm looking to trade it. And based on what I've seen and just a simple valuation, I've at least got my very first target here. I've got decent entry targets based on charts and looking at price movements historically on other stocks and the likelihood of what can happen. If this stock happens to, let's say, if it happens to gap up, let's say from the last closing price of 74.5 to 78 cents on strong volume, I mean, I'd have to get in on that. I just would. Then again, a small position again, it'd be like 30%, and then a large position much lower. You don't want to go in 100% ever on a position. I don't think that's ever the smart way to do anything, especially when it comes to mid-cap stocks, because you're not going to be right. You're not going to pick the bottom, right? So your first entry is going to be a good psychological thing for you. You put in 30%, and then you've got your stop loss set here. And then if you buy in really heavy, as close as possible to the stop loss, you're losing so much less money. You're risking so much less. The question is, well, what if it bounces here and shoots to the upside? Well, you're still making money. You're not making as much, but your concern shouldn't be profit. It should be minimizing loss. And like, if you focus on how much profit you're making, you're probably doing it wrong. You should maximize not taking losses. You should maximize preserving capital above all else. So that's pretty much a summary. Fair value. So that'll be a first exit target, really. Again, I underestimated quite heavily APT's bounce, but then again, that was a whole market bounce. Plus, it was looking at their equity and their financial standing, which is super healthy. Plus, COVID-19 had no impact according to APT, so that was a severe confidence booster for entering this stock. So you can see that's the 1 hour chart, by the way, and that shot up well beyond what I thought was possible. Nearly $24. I mean, I felt really stupid just saying 17. Just when you look at the chart, where was it? It was back here. It was on this candle here when it was $12, and I called it for $10.50 with a 9.50 stop. And no one really believed that 17 was a possible target. But it destroyed it, in fact. It went much higher than I thought it would. Now, OML, I don't know if I'd put them on the same standing as Afterpay. It's not. I don't think it's really a household name. I mean, I'm aware of it. I don't know. Has anyone heard of OML or U Media Limited or AdSense? In the chat, come on. There's 25 of you watching. I'm sure someone is at the keyboard who's actually heard of U Media Limited. They're an antisocial bunch. Nope. Okay. I think they're one of the largest advertising brand companies in Australia. I mean, for outdoor advertising, I can't think of another company. There was AdSense, but they were bought off. Yeah, right. So I heard of AdSense well before I heard of OML. I think they were on every bus stop that they're advertising on. And look, I think this is a conservative target as well. If the bounce occurs and we don't get stopped out, $9.50 should be pretty easy to hit. So what I would expect, and oddly enough, this stock didn't bounce on any targets whatsoever. So on the way down, OML didn't bounce on anything. Even these major horizontals here. Oh, okay, sorry, it bounced on intraday and then it just collapsed right through. That's the IPO horizontal price. That's the previous lowest low. And yeah, they just, at no point in time did they really bounce on any technicals whatsoever. It plummeted right down, which makes me more confident that this target is an absolute minimum. And it wouldn't surprise me if moved up, retested, carried on. So that's actually what you want to see. That would be ideal, is that scenario right there. Break, retest, carry on. What would suck is seeing this. A bounce at resistance. Because then you're not too sure if that's going to happen. It's less likely. So there you go. There's the price targets. I don't hold OML at the moment. I'm looking forward to finding a position on Tuesday, maybe Wednesday, depending on what happens on the price movements. Again, I don't like talking too much about what could happen, because again, it is very much an if X then Y situation, and I can't tell you what X is going to be, let alone Y. Oh yeah, JC Deco. They're in every roadside billboard in the corner. Yep. They're in every bus stop here as well. All right, that pretty much covers it. Have a happy remaining Easter.